Are raising questions around expected credit losses on financial assets. They raised that as a key matter for 2022. What were their concerns?
Well, I think, in this kind of rising interest rate environment, I think everyone expects that you might be holding bonds that might then get depressed in value. But I think that's something that we've already anticipated, and we've tried to stay on the shorter duration of that. So our book is not, long per se, and we're going to manage the risk that way.
And
I think that's what they're referring to.
And you're also holding a lot less bonds compared to some of the other peers in Tier 1, like Equity and KCB. So exposure there is not quite as heavy, for example, as they are.
Correct. And that's an important distinction, because we find that when you put assets to work with real clients, you tend to have a much better outcome. Not only are you serving a purpose, and you can see where the money is going, you can see the return. And that's really, at the end of the day, that's what banks are for. We're supposed to just intermediate between the need for capital. And so, lending to the sovereign might be something that you could do, but it cannot be the mainstay of your business.
But it is, admittedly, in the current environment, somewhat attractive, isn't it? We saw an issuance, I believe, this week where you had an infrastructure bond with a coupon rate over 14%, short-term paper. The 91-day T-bill is yielding 9-point-something% now. It must be fairly attractive to park cash there.
I would kind of disagree. At 9%, when you have LIBOR or SOFR going up to 6%, that's what they anticipate in the next few weeks or so. I just don't see how a 9% in shilling actually covers you for the risk, both for the currency and for the return. So I think there'd be more attractive times than there is right now. Put it that way.
All right, then. Let's talk about non-performing loans. According to the central bank, NPLs across the entire sector, 13.3% last year. Your NPLs coming in roughly 400 basis points below that. But you did raise loan loss provisions. What sort of speed bumps are you seeing in 2023?
So, first of all, our NPLs are lower than the market, as you pointed out. And I would also say they're very concentrated in 4 or 5 names. So it's not like a widespread systemic issue. In fact, just 5 names are 50% of our NPLs. And we always do take a conservative approach in how we provision. So we've taken that approach, and we provision probably in more caution than we should have. And so we don't anticipate that we're going to be in a position that's worse than we are in now. So we're looking actually for 2023 to be a much better year from a provisioning point of view.
With respect to the restructuring of loans that happened when the COVID-19 pandemic hit in 2020, 2021, has that all worked through the book? Are all those loans now back on a performing basis, or do you still have that overhang from the pandemic?
There is a bit of an overhang, but we've worked through it. There were sectors, as you know, that were hard hit, like tourism, hospitality, some specific sectors that saw more pain than others. But we've held the hand of the clients, and we've restructured those, and we've started to see things to come back. Tourism is back. Hotel occupancies are back up again. So we're seeing a decent return back. Obviously, there were some sectors that moved ahead quicker than others slower. But I would say that generally, the lingering effects of the COVID pandemic have left the system.
Dollar access problems. These have been a headline item pretty much across the country for the start of the year, most of Q1, a big chunk of 2022 and 2021. How has that affected these results? To what extent is it a drag on performance last year?
It's not a drag for us because, traditionally we do get significant dollar flows. If you look at our market share, we do punch above our weight in terms of dollar assets. And we have a pretty hedged portfolio in terms of Kenya shillings versus dollar. We lend out to dollars. We lend out dollars to clients that actually receive dollars. So we don't take that currency risk. And so traditionally, we've had those clients do well, even with the dollar strengthening, because they have a natural hedge as well in their business. So for us, it's not been a big problem. We've been able to manage it, and we continue to be a net provider of dollar liquidity into the market.
Are your clients struggling with it? Because we keep seeing all these complaints coming in from manufacturers, from importers saying, look, we need to get dollars, a certain X amount of dollars on time, but we go into the market and we simply can't find the amounts that we need at a price that makes sense. Pricing and liquidity is clearly a problem on the consumer side. I mean, at some point, that may then translate into your loan book.
I agree, but as I think that's also very temporary. It's a sentiment thing. I think anytime you have a currency depreciate so aggressively, people tend to sit on the sidelines. The people who have the dollars tend to sit on them because you're obviously earning a massive return on your dollars. So there's going to be a shift at some point where either dollar liquidity comes back and the central bank is able to come into the market. Secondly, we fix whatever interbank issues they are. And then thirdly, we just change the sentiment so that those who are even sitting on dollars can provide them to the market. But we're not there yet. And like I pointed out earlier, with the 9% treasury bond you're talking about, we don't have that much offshore interest. So that rate needs to get higher so that we compensate people for the currency risk. And maybe then we get dollar inflows again. So, but I honestly think that the technocrats and the right people are paying a lot of attention to this, to manage this so that we get back to a point where we don't have liquidity dollar flow problems.
All right, then I want to move on to the question of affordable housing. I saw in the presentation in the morning that the banks put out $267 million 267 million shillings in affordable housing loans. But considering the fact that, we have a housing deficit of, I believe it's 200,000 units a year, this almost looks like, a drop in the ocean. Presumably demand would be much, much higher. What sort of demand are you seeing in terms of order flow for these affordable mortgages?
Well, first of all, I would say that the supply on affordable housing is dismal. So, out of the estimated supply of 50,000 units a year or so, less than 2% are in affordable housing. So there's a structural problem. We're also not building the right houses. So it's hard then to say the banks are not funding that because we only follow the market. So we need to also deal that issue. Why is it that the developers and the constructors haven't found a sweet spot where they're able to put a lot more supply of affordable housing in the marketplace? Because for us, we're really indifferent. I mean, we look at a mortgage based on the equity you put and the value of the house. And that same model works for affordable and it works for a high-end house. So we really are just reacting to what the market demand is. But we remain a very, very big player in the mortgage market and a leader in that space. So we continue to work with other stakeholders to see how we can fix that structural mismatch.
Well, can these mortgage rates, these affordable mortgage rates, can they remain in single digits at a time when, you've got the Fed raising rates across the pond, which raises the cost of dollar debt? You've got the central bank here, which might eventually raise rates when they eventually meet at the end of the month for the next MPC meeting. Do we actually have strong odds of having affordable housing debt?
Yeah, we do. And remember, mortgages are 20 years, right? So they cut through cycles. We are in a difficult period right now, and I do expect that rates will go up. But when you smoothen out the curve, generally speaking, I think, if you look back 10 years and we've gone through a few cycles, mortgages have stayed quite sticky. Because again, real estate prices have gone up, and generally speaking, it's a safe investment because people's equity are increasing as the values go up. And also, a mortgage is probably the last thing you want to default on. So there's also that natural, I gotta protect my asset. It's probably the most important asset that I have. So we're quite bullish on the mortgage front. Yes, there will be some noise, but generally speaking, we take the long view.
All right, one last question for you. There was also a lot of talk today about acquiring or partnering with fintechs or MNOs. Do you have a target in mind already? And what skill sets, if any, will they be bringing into the bank that you don't already have?
It's a good question. I mean, the environment that we're operating in is evolving. There's a lot of growth in the fintech space, as you know. In East Africa, Nairobi remains a hub. A lot of the leading fintechs are setting up a hub in Nairobi. So first of all, we're getting a lot of competition from the fintechs. And then we recognize that, for us to give the same customer experience, we also need to have the same sort of approach that the fintechs have. We do have our traditional banking advantage, and that no one's going to take that away. We obviously have the trust of our customers because we've been around for 160 years. We understand risk. But as we get into this space where people want to do more than just banking in one space, we need to also start to get into their lives and into their customer journeys. And that's where we're looking for partnerships and collaborations. How do we remain relevant to you? Whether you want to buy a travel ticket, you want to pay school fees, you want to buy insurance, and create a platform. Yes, we remain your key banking customer, but we add on these other things that make you sticky to us. And so that's kind of what we're looking at. We might acquire, we might collaborate, we might partner, we might take an equity stake, but we recognize that the old just being a pure bank that has a bunch of brick and mortar space is not going to serve us in the future. And remember, we're also competing with the telcos. And as you know, there's a formidable telco competitor in Safaricom in Kenya. So we also have to make sure that we stay ahead of that pack.
So just to be clear, are we talking about, getting into the payment space, or is it a mix of payments plus lending? What specifically are you looking at?
It's payments, it's lending, it's anything that that a customer would need to do and they can do themselves digitally, whether it's asset management. People are looking now to see if they can invest into treasuries or equities and do it online. It's those type of things. We just want to be relevant. We want to be your partner for whatever lifestyle journey that you're on. So anything that provides us with best in class, we will look at.